Let's begin. When we started with AS10, we learned the objective of AS10 to start with. What is the objective? The objective is to learn how to recognize, how to depreciate, how to account in the case of retirement or disposal of the property, plant, and equipment. The scope of the standard clearly defines that this standard AS10 does not apply to biological assets, and it does not apply to wasting assets, and it also does not apply to investment property. AS10 doesn't apply to biological assets, wasting assets, and investment property. When we say the word biological assets, we mean those things which have life, living plant and animals, living plant and then talking about living plants. Usually AS10 is not applicable. However, there is an exception. Certain category of living plants are called bearer plants. Certain category of living plants are called to bearer plants. Accounting standard 10 is applicable. To bearer plants, AS10 is. Now, what do you mean by bearer plants? Bearer plants are living plants, which gives us agricultural produce for a period more than one accounting year, and they themselves will never be used as accounting agricultural produce, or the possibility of they themselves being used as agricultural produce is rare, and those will be called as bearer plant, and bearer plants are covered under accounting standard 10. Did you discuss the same? Yes. Then we came to definition. What is the definition of property, plant, and equipment? It is tangible item which is held for using as rental purpose, administration purpose, production of goods, or rendering of services with an expected future economic benefit of longer than a year from the same. If that is fulfilled, it is PPE based on the definition. But to record it in our accounts as a PPE, it has to fulfill recognition criteria. There are 2 points in recognition criteria. Number 1, FEB, future economic benefit. Number 2, RM, reliable measurement. We should be able to get economic benefit from this asset in the future. Next one, we should be reliably able to measure the price of this asset. If we can reliably measure the price of this asset, and if we can generate some future economic benefit from this asset, then this asset will be called as PPE, and it can be recognized in our books of accounts as PPE. The cost that is incurred before the asset is put to use or ready to be put to use is initial recognition. After the asset is been put to use, if you incur some cost, that will be called as subsequent cost. Subsequent cost will be usually charged to PL. Can subsequent cost be added to the cost of the asset? Yes, you can. But in order to add subsequent cost to the cost of the asset, it has to fulfill the recognition criteria. Recognition criteria is 2 important points. 1, future economic benefit. 2, reliable measurement. 1, future economic benefit. 2, if in case in the future you are going to get economic benefit from this and you can reliably measure this, then though the cost is incurred after the asset is ready to be put to use, it can be capitalized. Usually no, but if it is going to give future economic benefit, then yes, can be capitalized. There are certain equipment like standby equipment, service equipment, and then spare parts. These are usually not fulfilling the definition of PPE, then they are not PPE. For them to be taken as PPE, they have to separately fulfill the definition of PPE in individuality also. Are you getting it? Safety equipment, environment protection, or any other equipment that is used, pollution control, all of this, they can be considered as PPE. They protecting the environment, they ensuring the safety of the workers within the entity is good enough for fulfilling the criteria of future economic benefit. Am I right? And asset can be purchased by giving cash, but it's not a condition that asset has to be purchased for paying cash. Sometimes you might buy the asset without paying cash also. That's called purchase of the asset for non-cash consideration. We'll discuss that also eventually. The cost at which the asset has to be recorded is divided into 3 major classifications. Purchase price, directly attributable cost, cost of dismantling. Purchase price, cash price that you pay to buy. If in case you're paying in deferred installments, then that credit is given at a cost of interest. That interest is not part of the cost unless AS16 allows us to take it as a part of the cost. So we should always take cash price. Even if you buy the asset on hire purchase, the cost of the asset to be taken is cash price. Did everyone understand this? And the trade discount, if any, should be deducted. What do we do with regard to our GST? If input tax credit not available, add it. If input tax credit available, don't add. That's the logic. And then after that, what do we do? If we have cash consideration, okay. If we don't buy the asset for cash consideration, if there is non-cash consideration, then what should we check? Point number one to be checked, commercial substance. Is there commercial substance? Meaning, with this asset, cash flow, without this asset or the old asset, cash flow, is it same or different? If the cash flows with the asset which was there before this and cash flows with the asset which is there with this are same, then there is no commercial substance. You cannot make profit or loss on this exchange. It is actually exchange. There is no purchase sale. The asset that we get should be recorded at the book value of the asset that we had. Asset that we get should be recorded the book value of the asset that we had previously and we gave no. What if the cash flows from the asset before exchange, cash flow from the assets after exchange are different? Then it is not exchange. It is sale of the old asset. Consideration was due to be received. Instead of receiving consideration in cash, we received the new asset. Then the cost at which the new asset is to be recorded. The cost at which the new asset is to be recorded is fair market value of the asset given or fair market value of the asset received, whichever is more clearly and evidently available. If both are clearly and evidently available, then fair market value of the asset given will have the priority over the fair market value of the asset received. I hope everybody got this. Yeah. What did we discuss after this? After this, we went on to directly attributable cost. What and all will it include? It will include all the costs or all the expenditure incurred till the time the asset is ready to be put to use. All the expenditure incurred till the time the asset is ready to buy. Which asset to buy? If you take some expert advice, that cost. And after you buy, if you pay some loading, packaging, transportation, octroi, freight, unloading, unpacking, and all of these taxes till the time you bring it to your factory, and there site restoration cost, site setup cost, installation cost, assembly fee, engineering fee, labor cost, excluding profit margin, internal profit should not be taken. All these costs have to be included. If in case you would have to temporarily move the old factory to another place for the installation of this machinery, that cost will not be included. Temporary site shifting, temporary office shifting, or the product that you're going to manufacture using the machine. If you're going to do advertisement, that's not included. Selling expenses, administration expenses, advertising expenditure, new product launch expenditure, new service launch expenditure, inauguration expenditure, all of these are not included in the cost of the asset. Are you getting it? Very good. Lastly, we spoke about cost of dismantling. Whenever we come to the end of the useful life of the asset, we need to remove the asset. So today I'm installing the asset. After 5 years or 6 years or 10 years, when I have to remove the asset, I might have to incur some money. And that money, what I pay at the end of the useful life of the asset, I have to anticipate or expect as of today. How? I'll anticipate what is it that I have to pay after 5, 6 years, discount it using the present value factor and identify the present value of the future cash outflow. And that has to be added to the cost of the asset. Asset is purchased for 1 lakh. 20,000 needs to be paid on removal. Present value of it will come to about 12,000. 12,000 I don't have to pay right now. I'll pay 12,000 after 5 years. I'll pay 12,000 after 5 years. But today I would have to expect it or anticipate it. That 12,000, though I don't pay, it will be added to the cost of the asset. And because I don't pay, I'll credit it to provision account. So journal entry will be asset account debit about 1 lakh 12,000. Credit cash or vendor for asset 1 lakh. 12,000 should be credited to provision for dismantling cost account. And that provision will get added by interest cost every year, so that at the end of the useful life, we have the provision equal to the amount that you should actually incur. And if in case the provision amount doesn't match with the actual amount, that is difference between estimate made and the actual amount of expense, that will be booked in P&L of that year in which that excess is incurred, and that is not a prior period item. I hope you understood. Then going further, we discuss subsequent cost. Usually subsequent cost refers to the cost what is incurred after the asset is put to use. And like I mentioned, such cost incurred after the asset is put to use or ready to be put to use, it should be generally charged to PL. It's like repairs and maintenance expenditure. However, if it is major expenditure, if that expenditure is vital in making the asset revive, then such cost, if it fulfills recognition criteria of reliable measurement and future economic benefit, then it can be added to the cost of the asset. I hope you all understood. Example can be major inspection done for overhauling an aircraft. All of these are the expenditures. Then depreciation. See, depreciation is systematic allocation of the useful life, systematic allocation of depreciable amount over the useful life of the asset. If the useful life of the asset is about 10 years, if the cost of the asset is 1 lakh and scrap value estimated is 10, 1 lakh is what you pay to get the asset. 10,000 is what you get at the end of the useful life. So throughout the useful life, decrease is only 90,000 rupees. That 90,000 which is decrease in the cost from 1 lakh to 10, that 90 should be written over that useful life. That is depreciation. Depreciation should start the moment asset is ready to be put to use, even though we don't use it immediately. The asset is ready in November, asset is actually put to use in March, we started depreciating from November. I hope you remember. And we should stop depreciating when the asset is derecognized or disposed. And there is one more situation where you stop depreciation. What is that? That original cost of the asset minus depreciation will come to carrying amount. That carrying amount is equal to residual value now. The residual value or scrap value that you get at the end of the year when you sell. So this carrying amount, if you depreciate little more, it will become lesser than scrap value. Meaning when you sell it at scrap, you will make profit. If that is the case, don't reduce the carrying amount below scrap value. Keep the carrying amount at scrap value. Stop depreciating. Asset is already fully depreciated. Asset is already fully, you stop depreciating, but you continue to use it in the business till the day you want. The day you sell, you will not make profit, you will realize that scrap value. Are you getting it? Then the next point that you should notice, depreciation is usually picked not for each item of the asset, but for each component. A group of assets will be depreciated under the same method using the same technique. You have buildings, all the buildings will follow same technique, same method. However, among the buildings, some are office buildings, some are factory buildings. You can use different method for factory buildings, different method for office buildings. Are you getting it? But you have factory A, factory B, factory C. All the three would have to use same method and would have to do depreciation the same way. Policy of depreciation and the estimate for depreciation should be almost in similar lines for both assets which are in similar nature. Are you getting it? The next point that you should note is what is the basis for computing depreciation? The basis is two important things. One is the expected useful life, economic benefit pattern, and the useful life. These two will decide the method of depreciation that we can follow. Not all the methods of depreciation that you read in your previous levels is applicable here. As per ASTN, only three levels or three methods of depreciations are allowed. One, straight line method. Two, diminishing balance method. Three, production units method. And the factors influencing depreciation is historical cost of the asset, the price at which we bought, useful life of the asset, period for which it can be used, residual value, the money that you get at the end of useful life. And this useful life as well as residual value are accounting estimates as per AS5. And if in case this estimate changes, we have to give prospective effect. And at the end of each accounting period, we need to check if there is change in accounting estimate. There might be change. Sometimes you can check it every 3 years, 5 years. If the asset is less volatile. If the asset is very volatile, you might have to check every year. If the asset is not volatile, you can check once in 5 years times. So depends upon the nature of the asset. But whenever there is change in accounting estimate like useful life or accounting estimate like scrap value or accounting estimate like expected usage pattern of the asset, then the depreciations will change and it has to be given prospective effect. What effect? Meaning from the year of change, you start giving the impact. You don't have to revise the past numbers. And like I mentioned, these three methods, how do we pick between these three methods? It is based on the pattern of usage of the asset or future economic benefit. If you expect the asset to produce same units, expense same, benefit same, and the sale revenue same from the asset every year, then you can follow SLM. If it is decreasing from year to year, then you can follow WDV. If it varies with the level of production, then you can follow production units method. I hope you understood. Then I mentioned no cost of dismantling or site restoration. Cost of dismantling is breaking the asset into parts before it's being discarded. Decommissioning liability is removing the asset from its site. And then site restoration is to install the asset. You might have modified the walls, roof, flooring or something. But when you remove the asset, you need to restore the land, building, flooring, roofing to back it to its original place. To do that, you will incur that expense. No, that is site restoration cost. This will be actually incurred at the end of useful life. But you need to estimate it, anticipate it, discount it using the present value factor to today's date. Present value of the future cash flow has to be added to the cost on the beginning. I hope you understood. If in case this changes, the liability changes, provisioning, discounting rate changes, or the useful life changes. So you might have to remove the asset at the end of 10 years as per original asset, as per original estimate. Later when you revise the useful life, It came to 8. So you have to remove the asset after 8 years only. Then that number of years of discounting will change, or the rate at which you are discounting will change, or expected amount that you should pay will change. Many of these changes, and the provisioning liability changes. No, you agree with me? How to account for that is what I've given here. That's something that you can take lightly. That's not there. Actually, discounting and inclusion in the asset cost only, you don't have any questions. You've done it. But I told you if that change is there, we'd have to adjust for such change also. Okay. Leave that aside now for now. Let's go forward. PPE, once it is recognized at cost, no, at the end of every year, when you have to value the PPE in the balance sheet, you have two models available. One is cost model, second one is revaluation model. Under cost model, we'll record the asset under the original cost and deduct the accumulated depreciation. Also deduct impairment loss if any. Impairment loss, we'll discuss it in detail in AS 28. We will deduct impairment loss if any, and that gives the book value or the carrying amount of the asset. Then we have another method called as revaluation model. Under revaluation model, what we do is we won't find the book value of the asset as original cost minus accumulated depreciation. What we do is we will check what according to us is the right value for the asset. And irrespective of what is the original cost minus accumulated depreciation, we want to show the asset at that value. For example, asset's original cost is 1 lakh. Accumulated depreciation is 10. Carrying amount becomes 90. I feel the asset's right value is 75. So 90 is not the right value. 1 lakh minus 10 is 90, but I want to show it at 75. I will undervalue the asset by 15,000. I will do downward revaluation of the asset. Alternatively, let's say the asset is 1 lakh, accumulated depreciation is 10. The book value comes to 90, but I feel the asset is worth 95,000. Can I change the value of 90 to 95? Yes, I can. I'll take 90 to 95 by increasing the value of the asset by 5. That is called upward revaluation. How do we treat this? Very simple. If in case you revalue the asset upward, it will be credited to revaluation reserve. It will be credited to revaluation. If in case we revalue the asset downward, it will be credited to, sorry, it will be debited to P&L. Sometimes you have to check, is it upward revaluation or is it reversal of downward? Is it downward revaluation or is it reversal of upward? See, if I am revaluing the asset upward for the first time, simple, PPE to revaluation reserve. If I am revaluing the asset downward for the first time, P&L to PPE same. Now, I am increasing the value of the asset, but the same asset was previously downward revalued. Then to the extent it was downward revalued in the past, I would have debited P&L. Now, I will credit P&L to that extent and then debit PP. Previously, I had downward revalued the asset by 10. Now, I am upward revaluing it by 8. Journal entry will not be PPE to revaluation reserve. It will be PPE to P&L. 8,000. Up to 10, I will do this. What if the downward revaluation was 10? Now, upward revaluation is 12. When I did downward revaluation, I'll write P&L to PPE 10. Now, when I am doing upward, I call it not upward, I'll call it reversal of downward to the extent of 10 and upward only to the extent of 2. So, basically, I'll do the entry as PPE account debit 12,000, credit P&L by 10, credit revaluation reserve by 2. And when I do downward revaluation of the asset, I'll write P&L to PPE. But before I write P&L to PPE, I would have to check if this asset was previously revalued upwards. If the asset was previously revalued upward by 10, now I am revaluing it downward by 8. I won't write 8,000 debit to PL. Whatever revaluation reserve was previously created will be debited. My entry will be revaluation reserve account debit to PPE account. I hope everybody got this. The next thing that I would do is, what if my asset was revalued upward by 10 and now it is going to be downward revalued by 12? When I revalued upward, I wrote PPE to revaluation reserve 10. Now, when I say downward revaluation by 12, I am actually not doing downward revaluation by 12. I am basically reversing the upward revaluation of 10 and I am doing downward revaluation of. I will credit my PPE by 12, debit P&L by 10 and debit revaluation reserve by 10. I hope everybody understood this. Then next thing that I would want you to know is what to do with this revaluation reserve that is created. Revaluation reserve that is created, there are two treatments. One, you can transfer it to statement of profit or loss a la P&L reserve, retained earnings over the useful life in the pattern of depreciation. First option. Second option, instead of doing this, what you can do is entire amount that you created revaluation reserve can be kept in revaluation reserve only. Till when? till the date the asset is derecognized or disposed. The day the asset gets derecognized or disposed, that day I'll transfer the entire amount to my reserve, general reserve or P&L reserve. I hope you understood this. It's an option that's there with me. Okay, very good. And we need to check for revaluation often. If the asset is very volatile annually, if it is less volatile, then in 3 to 5 years time. Like how we apply depreciation here also is applied for the entire group. If I have group of buildings, I need to do revaluation model for all buildings. I cannot say I'll do for building A, I won't do for building B. Building A cost model, building B revaluation model. No. However, building A is factory building, building B is office building. Can I follow revaluation model for factory and cost model for office? Yes. I have motor vehicles. Some are used to transport people, some are used to transport goods. There are two different class of assets. You can follow two different models. But if all the vehicles are used for transportation of goods, then for that entire group, you need to follow either revaluation model or cost model. For one car, for one truck, you can't say follow revaluation and rest of the trucks cost model, not at all. I hope you understood. Then derecognition of the asset. See, we recognize it as a PPE when there is future economic benefit. We stop recognition of as PPE. We will do derecognition when it is stop giving it is stopping to give us future economic benefit. Meaning from this asset there is no use to us, or we have decided to sell the asset. When we sell or when there is stoppage in future economic benefit, then it will be de-recognized. What will we do? De-recognize. Profit or loss arising will be booked to P&L account, and when to recognize this profit is told by AS9. Basically on the transfer of risk, reward and effective control. Remember substance over form. It's not legality that matters, it's accounting reality that matters. Paperwork is not done, but consideration is received and asset is given this year. We have to book sale this year, we have to book profit this year. Though the legal deed is not yet signed. Why? AS9 says that what is important is substance over form. Accounting reality prevails over mere legality. Then let's talk about retirement. Retirement, like we all know in our daily life terms, is person is stopped working but it is not yet dead. You stop working and then get ready to die very soon. That is retirement. For an asset. Asset is no longer used in production of goods. Asset is no longer used in rendering services. But asset is not sold yet. It is kept ready for sale. That is retirement. If the asset is retired, it is no longer giving us future economic benefit, then I no longer have to apply historical cost model for the same. I will value it like inventory. I'll value it like current asset, like how you value current investments in years 13. I'll no longer record it at historical cost. I'll record it at the carrying amount, or I'll record it at the net realizable value, whichever is less. Let's say its original cost was 1 lakh. It is depreciated by 90,000. So its book value is now 10,000 or carrying amount is 10. But when I sell, I can sell it only for 6. Carrying amount 10, but I can sell it only for 6. When I sell, I'll make 4,000 loss. Don't wait for the date of sale. Record it today only. Today, change the value of the asset from 10 to 6, 4,000 you book loss to PL because it is retired asset. However, if the assets carrying amount is 10, 1 lakh original cost minus 90,000 accumulated depreciation, and its expected realizable value is not 10, expected realizable value is 12,000. So book value 10 can be sold for 12. If you sell, you will make profit. Don't book profit. Record it at 10 only. That 2,000 profit will be booked when you sell. Why? Conservatism. What is the reason? Account for all expected expenses and losses, but not for expected incomes and account for all expected expenses and losses, but not for expected incomes and very good. Disclosure requirements. What are the disclosure requirements as per accounting standard 10? It's very simple. Yeah. You need to show each class of assets separately, method of depreciation separately, useful life of the asset separately, what is the gross carrying amount separately, accumulated depreciation separately, revaluation if any separately, retirement of the asset separately, disposal of the asset separately. All of this has to be disclosed separately. This is a quick revision of the entire standard accounting 10, which is on property, plant and equipment. I hope you understood. Yes.